December 12, 2025, a bureaucratic report lands on the desks of analysts at the U.S. Treasury Department. It's called the Treasury International Capital Report, the TIC data, a monthly accounting of who owns American debt. Most people ignore it. Spreadsheets and decimal points don't make headlines. But buried in those numbers is something that should terrify anyone paying attention. China, the largest foreign holder of U.S. Treasury securities for over a decade, has dumped $127 billion of American debt in just 18 months. Their holdings have collapsed from $860 billion in June 2024 to $733 billion as of November 2025. That's a 15% reduction in a year and a half. The pace is accelerating. Now, financial analysts immediately started talking about what this means for interest rates, for the dollar, for American borrowing costs. All valid concerns. But they're missing the larger story. Because during that exact same 18-month period, while China was selling American paper, they were buying something else. Something physical. Something that can't be printed, can't be frozen by sanctions, can't be seized by a keystroke in Washington. They were buying silver. According to Chinese customs data, silver imports surged from around 4,800 metric tons in 2023 to over 6,200 metric tons in the first 10 months of 2025. That's a 29% increase. Let me be clear about what we're witnessing. The second largest economy in the world is systematically converting paper promises backed by the U.S. government into physical metal that has been a store of value for 5,000 years. This is not about investment returns. This is not about portfolio diversification in the way your financial advisor talks about it. This is preparation. This is China building a war chest for a world where the dollar is weaker, where American debt is toxic, where the only things that matter are the physical commodities you control. And if I'm reading the pattern correctly, we are watching the early stages of the largest commodity corner since the Hunt brothers tried to monopolize silver in 1980. Except this time, it's not two billionaire brothers from Texas. It's a nuclear superpower with $3 trillion in reserves and a plan to reshape the global order. The implications are staggering for the dollar, for American power, and for anyone holding silver or planning to. Let me show you what I found. To understand what's happening, you need to understand the history. China became America's largest creditor through a very specific process. In the 1990s and 2000s, China transformed itself into the factory of the world. Cheap labor, massive infrastructure investment, and currency manipulation created the perfect export machine. Chinese goods flooded American stores. Walmart shelves filled with products stamped made in China. The dollars flowed east. Billions, then hundreds of billions, then trillions, but China didn't spend those dollars. They couldn't, not all of them. If they tried to convert all those dollars into yuan at once, it would cause their currency to appreciate, making Chinese exports more expensive and killing the golden goose. So they did what any country does with excess dollars. They bought U.S. Treasury securities. By 2013, China held $1.3 trillion in American government debt. They were the dominant creditor, the banker to the empire. It was a symbiotic relationship. America got cheap goods and cheap financing for its deficit spending. China got employment for its hundreds of millions of workers and a stable place to park its dollar surplus. But that relationship has been dying for a decade. Let me show you the timeline. 2013, peak holdings at $1.3 trillion. 2016 dropped to $1.1 trillion, down $200 billion in 3 years. 2020, holdings at $1.06 trillion, relatively stable through the pandemic. 2022, dropped below $1 trillion for the first time in years, ending around $970 billion. 2024 down to $860 billion by mid-year, the decline accelerating. 2025, down to $733 billion as of November. From peak to present, China has liquidated $567 billion in U.S. Treasury securities, over $500 billion. That's not portfolio rebalancing. That's a strategic exit. The official explanation from Beijing is always the same: diversification, concern about U.S. fiscal deficits, worry about dollar depreciation, all reasonable-sounding justifications. But here's what that explanation doesn't tell you. Where is that $567 billion going? Because money doesn't vanish. When you sell treasuries, you receive dollars. Then you convert those dollars into something else. Euros, yen, gold, real estate. Infrastructure, something, and according to the patterns I've been tracking, a significant portion is flowing into physical commodities, specifically gold and silver. Let me start with gold because it's easier to track. China's central bank officially added approximately 300 tons of gold to reserves in 2023 and 2024 combined. At average prices, that's roughly $18 billion worth. Significant, but that only accounts for $18 billion of the $567 billion in Treasury sales over the decade. Where is the other $549 billion? Some went to other currencies, building up euro and yen reserves. Some went to IMF special drawing rights. Some funded domestic infrastructure and Belt and Road Initiative projects in Asia, Africa, and Europe. But here's what most analysts are missing. A significant portion, went into strategic commodities that don't show up in official central bank reports. And silver is one of them. Chinese Customs publishes monthly import and export data. It's public information, available to anyone who knows where to look. And the silver numbers tell a story that should be front-page news. 2020, China imported approximately 4,200 metric tons of silver, roughly 135 million ounces. 2021, imports rose to around 4,900 metric tons, about 157 million ounces. 2022, approximately 5,100 metric tons, about 164 million ounces. 2023, around 4,800 metric tons, 154 million ounces, a slight dip. 2024, imports increased to around 5,500 metric tons, roughly 177 million ounces. 2025, through October alone, imports already reached 6,200 metric tons. If that pace continues, they're on track for over 7,400 metric tons annually, approximately 238 million ounces. From 2020 to 2025, China's silver imports increased by 76%. That's not noise. That's not random fluctuation. That's a deliberate, sustained accumulation. But here's what makes this even more significant. China is also the world's third largest silver producer. They mine approximately 3,700 metric tons annually from domestic sources, about 119 million ounces. So if we do the math, China is producing 119 million ounces domestically and importing 238 million ounces. That's a total supply of 357 million ounces of silver flowing into China every single year. Where is it going? The official answer is industrial use. Solar panels, electronics, batteries, all legitimate applications. China manufactures roughly 80% of the world's solar panels. And each panel requires silver paste for electrical connectivity. That demand is real. But here's the problem with that explanation. China's solar panel exports have been relatively stable or growing only modestly. If all that silver was being embedded in solar panels destined for export, we would see a proportional increase in panel exports. We don't, which means a significant portion of that silver is staying inside China. Either it's going into domestic solar installations, which is possible, or it's going somewhere else. And I believe that somewhere else is strategic stockpiles. China doesn't publish data on strategic commodity reserves for most metals. They publish oil reserves, grain reserves, things that are politically sensitive to food and energy security. But they do not publish reserves of silver, gold, rare earths, or other strategic minerals. Why? Because those reserves are strategic leverage. If the world knows how much you hold, you lose negotiating power. You lose the element of surprise. And in my assessment, China has been quietly building a massive silver stockpile for the past 5 years while simultaneously liquidating used treasuries. Let me show you the mathematical connection. China dumps $127 billion in treasuries over 18 months, from June 2024 to November 2025. During that same period, silver averaged around $27 per ounce in mid to late 2024, then rallied to the current price near $59. Let's use a conservative average of $35 per ounce for the entire 18-month period. If China wanted to convert just 10% of that $127 billion into physical silver, that's $12.7 billion. At an average price of $35 per ounce, that equals approximately 363 million ounces. Now compare that to China's excess imports above historical norms over the same 18 months. Roughly 150 million ounces above the 2020 to 2022 average. Even a 10% conversion of Treasury sale proceeds could account for their entire import surge. And if they're converting more than 10%, which I strongly suspect, the numbers become staggering. What if they're converting 20%? That's $25.4 billion into silver. At $35 per ounce, that's 726 million ounces. But that would dwarf their visible imports, which means it would have to be flowing through unofficial channels, off-market transactions, direct refinery purchases, vault transfers that never show up in customs data because they reclassified as something else, or handled by state-owned entities that do and report publicly. Is that possible? Absolutely. China operates state-owned enterprises and sovereign wealth funds that can acquire commodities without public disclosure. When you're accumulating a strategic asset, you don't advertise. You move quietly through layers of intermediaries, using every tool available to hide your footprint. Because the moment the market realizes what you're doing, the price moves against you. Now let me explain why silver and not just gold. Gold is the traditional reserve asset. Central banks have held gold for centuries. It's monetary. It's recognized globally. But gold has two fundamental problems from China's strategic perspective. First, the gold market is enormous. Gold's total market capitalization is approximately $18 trillion. China can buy gold, and they are buying gold, but moving the needle requires truly massive purchases. Spending $18 billion on gold, as they did over 2 years, barely registers as a blip in the global market. You need hundreds of billions to make a strategic difference. Second, gold doesn't have the industrial applications that silver does. Gold is beautiful, gold is permanent, gold is monetary. But you don't need gold to manufacture solar panels. You don't need gold for military electronics. You don't need gold to build 5G infrastructure or electric vehicle components. If China is preparing for conflict, sanctions, or prolonged economic confrontation with the West, they need industrial metals, not just monetary metals. Silver is unique in human history. It is both monetary and industrial. For 5,000 years, silver has been money, a store of value, a medium of exchange. But in the modern world, silver is also indispensable for technology. You cannot build solar panels without silver paste. You cannot manufacture certain military-grade electronics without silver. You cannot construct advanced medical equipment without silver. Its electrical and thermal conductivity properties are unmatched. If China is stockpiling for strategic reasons, possibly preparing for a Taiwan scenario or an extended confrontation with the United States and its allies, silver is more valuable than gold in some critical ways. It's the metal you need for autarky, for self-sufficiency, for the ability to manufacture your own technology if supply chains are severed. And here's the kicker that should keep Western policymakers awake at night. The silver market is tiny. Total investable silver supply globally is estimated at roughly $50 billion. Compare that to gold at $18 trillion. Silver's entire investable market is less than 0.3% the size of gold's. If China wanted to corner the market, if they wanted to accumulate a dominant position the way the Hunt brothers tried in 1980, they could do it. And they could do it with a fraction of their Treasury liquidation proceeds. $50 billion is pocket change for a country sitting on over $3 trillion in foreign exchange reserves. They could buy the entire above-ground investable silver supply and still have $2.95 trillion left over. That's the scale we're talking about. That's the asymmetry that makes this so dangerous. Let me give you the geopolitical context, because none of this is happening in a vacuum. Why is China dumping treasuries now? Why 2024 and 2025 specifically? I believe there are 3 interlocking reasons, and they all point to preparation for confrontation. First, the US-China relationship has deteriorated beyond repair. We are no longer in a phase of strategic competition. We are in a phase of strategic hostility. Taiwan tensions are at the highest level in decades. The US has been arming Taiwan with advanced weapons systems. American lawmakers visit Taipei regularly, infuriating Beijing. China conducts military exercises simulating blockades and invasions. Both sides are preparing for a scenario that was unthinkable 10 years ago. Trade wars have become technology wars. The United States has imposed sweeping export controls on semiconductors, chip-making equipment, and artificial intelligence technology. The goal is explicit: to prevent China from achieving technological parity, to maintain American dominance in the industries that will define the 21st century. China views this as an attempt at containment, at strangling their development, at keeping them subordinate forever. Second, China learned a brutal lesson by watching Russia. In February 2022, Russia invaded Ukraine. Within days, the United States and European Union froze approximately $300 billion in Russian foreign reserves. Central bank assets, sovereign wealth fund holdings, all frozen, inaccessible, effectively confiscated without due process. Russia discovered the hard way that holding reserves in dollars and euros means the West has a veto over your money. If they decide you're an enemy, your reserves vanish with the stroke of a pen. China's leadership watched this closely. They understand that if China moves on Taiwan, even a limited blockade or quarantine operation, the American response will include massive financial sanctions. Freezing reserves, cutting off dollar access, ejecting Chinese banks from the SWIFT international payment system, seizing assets held in Western jurisdictions. The playbook is already written. Russia was the test case, and so China is preparing. They are systematically reducing their exposure to assets that can be frozen, confiscated, or weaponized against them. U.S. Treasury securities are the most vulnerable of all because they exist as electronic entries in American financial systems. With a few keystrokes, the U.S. Treasury could freeze China's holdings, making them worthless overnight. That's an unacceptable strategic vulnerability for a country preparing for potential conflict. Gold held in vaults in New York or London can be frozen. But gold held in vaults in Beijing cannot be touched. Silver stored in Chinese warehouses cannot be seized. Physical commodities on Chinese soil are sanction-proof. That's the logic driving this shift. It's not about investment returns. It's about survival in a world where economic warfare is the first weapon deployed. Third, the U.S. fiscal situation is deteriorating beyond repair. The national debt has surpassed $36 trillion. Annual deficits are running around $2 trillion, even during periods of economic growth. Interest payments on the debt now exceed $1 trillion per year, more than the defense budget. The Congressional Budget Office projects that within a decade, interest costs will consume 20% of all federal revenue. China looks at these numbers and sees an unsustainable trajectory. They see a debtor nation that has no plan to balance its budget, no political will to raise taxes or cut spending, no path forward except printing more money and issuing more debt. At some point, the market will lose confidence. At some point, buyers will demand higher interest rates to compensate for the risk. At some point, the dollar's reserve status will crack. China doesn't want to be holding the bag when that happens. They don't want to be the last creditor standing with worthless paper when the music stops. So they're exiting now, while they still can. While there are still buyers for U.S. Treasuries, while they can convert dollars into real assets at reasonable prices. The timing of this liquidation is not coincidental, it is calculated. It is preparation for a world that looks very different from the one we've lived in for the past 80 years. Let me walk you through the 4 stages of China's strategy as I see it unfolding. Stage 1 was dollar reserve accumulation. From roughly 2000 to 2013, China ran massive trade surpluses with the United States and the rest of the world. They accumulated over $1.3 trillion in Treasury securities, becoming America's largest creditor. This was the integration phase. China needed dollars for international trade. They invested in Treasuries as the safest, most liquid dollar-denominated asset. It was rational, mutually beneficial, the foundation of what some called Chimerica, the intertwined economies of China and America. Stage 2 was plateau and revaluation. From 2013 to 2020, Treasury holdings stabilized around $1 trillion. China began to question whether dollar dominance was in their long-term interest. They started discussing alternatives, building regional trade agreements, promoting the renminbi for international settlement. They quietly began buying gold. Silver imports started to rise modestly. This was the period of strategic doubt, when China's leadership realized that dependence on the dollar was a vulnerability, not an asset. Stage 3 is strategic liquidation and commodity accumulation, from 2020 to the present. This is the phase we are in now. Treasury holdings are dropping aggressively, from $1.06 trillion down to $733 billion, a 31% decline in just 5 years. Simultaneously, gold purchases have accelerated. Silver imports have surged. Stockpiles of critical minerals are being built. Physical commodities are replacing paper assets. This is the preparation phase. China is building the war chest, the strategic reserves, the self-sufficiency that will allow them to withstand sanctions and blockades. Stage 4 will be decoupling and confrontation, likely to unfold between 2026 and 2030. In this phase, China completes the transition away from dollar dependence. They hold minimal treasury securities, just enough for day-to-day trade settlement. They have massive commodity stockpiles. Their financial system is insulated from Western pressure. Global silver mine production is approximately 820 million ounces per year. That's the total amount of new silver being extracted from the earth annually. Industrial demand, electronics, solar panels, medical equipment accounts for around 600 million ounces. Investment demand, coins, bars, ETFs, historically runs about 200 million ounces. Jewelry and other uses take another 200 million ounces. Total demand is roughly 1 billion ounces. Supply is 820 million ounces. That's a structural deficit of 180 million ounces every year. That deficit gets filled from above-ground inventories, from recycling, from government stockpile sales. The market has been in deficit for years, but somehow the price remained depressed until recently. Why? Because the visible inventories were large enough to cover the gap, and because investment demand was modest. Silver was seen as an industrial metal that moved with the economy, not as a strategic asset. But now consider what happens if China is absorbing 238 million ounces annually through imports, plus producing 119 million ounces domestically. That's 357 million ounces flowing into China each year. If even half of that is going into strategic stockpiles rather than immediate industrial consumption, that's 178 million ounces being removed from the global market annually, sequestered behind Chinese borders where it will not re-enter circulation. The global deficit is 180 million ounces. China alone could be absorbing almost the entire deficit. And if they're also restricting exports, which they began doing in late November 2025 by tightening export license requirements, then they are simultaneously a massive buyer and a supply constrictor. That is textbook squeeze dynamics. What happens in a squeeze? Price rises until demand is rationed. Marginal buyers are forced out. Industrial users panic and start hoarding. The Hunt brothers understood this in 1980. They tried to corner the silver market by accumulating physical metal and futures contracts. At the peak, they controlled an estimated 100 million ounces, and the price shot from $6 to $50 in a matter of months before regulators intervened and the scheme collapsed. But China is not the Hunt brothers. China is a sovereign nation with effectively unlimited financial resources and no regulators to stop them. If they have been quietly accumulating for 5 years, they could already control 500 million to 1 billion ounces. That would represent 10 to 20% of the entire above-ground silver supply. And unlike the Hunts, China doesn't need to liquidate for profit. They can hold indefinitely. They can use it for industrial production. They can sit on it as a strategic reserve. They have no forced sellers. When that realization hits the market, when traders and industrial users understand that a significant portion of global silver supply is locked away and unavailable, the price discovery will be violent. We could see moves of $20, $30, $50 in a matter of weeks. Let me give you a timeline projection based on current trends. 2025, the present moment. China holds $733 billion in treasuries, down from $860 billion just 18 months ago. Silver imports are surging. Export restrictions are beginning. Silver is trading around $59, up 85% year to date. The move has already started. The early adopters, the people paying attention to the data, have already positioned themselves. But the broader market is still asleep. 2026, continued liquidation. If China maintains the current pace, they will drop below $600 billion in treasury holdings by the end of the year. That's another $133 billion in sales. If just 10% of that flows into silver, that's an additional $13.3 billion of buying pressure. At an average price of $60, that represents 222 million ounces of potential demand. Meanwhile, if export restrictions remain in place or tighten further, global supply continues to contract. Industrial users start to panic about availability. Silver could push toward $80 to $100 in my assessment. 2027 acceleration phase. China's Treasury holdings drop below 500 billion, signaling near-complete exit from dollar assets. Commodity stockpiles are massive. If Taiwan tensions escalate significantly or if a military confrontation begins, silver could spike to $120 to $150 as industrial users and investors stampede into physical metal fearing supply disruptions. 2028 to 2030, new equilibrium. Either the confrontation has occurred and silver stabilizes at a much higher structural level, $100 plus, or tensions ease somewhat and silver corrects but remains elevated, staying above $70. Either way, the era of $20 silver is over. The market has fundamentally repriced based on strategic scarcity and geopolitical risk. This is not speculation. This is pattern recognition based on documented government data and historical precedent. The Soviet Union collapsed in part because they were overly dependent on oil revenues and couldn't adapt when prices fell. China learned that lesson. They are making sure they control critical physical resources so they cannot be economically strangled. Now let me address the counterarguments because I know some of you are skeptical and you should be. Argument 1. Correlation does not equal causation. Just because China is selling treasuries and buying silver simultaneously doesn't prove that one is funding the other. They could be independent decisions driven by different factors. Fair point. But when you observe a country systematically reducing holdings of one asset class while simultaneously increasing holdings of another, during a period of heightened geopolitical tension, connecting those dots is not wild speculation. It's logical inference based on strategic incentives. Argument 2. China's silver imports are purely for industrial use, particularly solar panel manufacturing. They're not stockpiling for strategic purposes. Possible. China is indeed the dominant solar manufacturer, and that requires enormous amounts of silver. But industrial demand alone does not explain a 76% increase in imports over 5 years when solar exports have not increased proportionally. If all that silver was being embedded in exported panels, we would see corresponding export growth. We don't. Something else is absorbing that metal. Argument 3. China cannot hide massive silver stockpiles. Everything eventually gets reported or discovered. Not true. China has repeatedly demonstrated the ability to accumulate strategic commodities without disclosure for extended periods. They did it with rare earth elements for decades, controlling global supply while the world remained oblivious until it was too late. They're doing it with gold right now, buying far more than they officially report. Silver is easier to hide than gold because the market is smaller and less scrutinized by international observers. Argument 4. If China were stockpiling aggressively, silver prices would already be much higher. The market would have figured it out. Maybe. Or maybe their accumulation has already driven silver from $18 in 2020 to $59 today. That's a 220% move in 5 years. Perhaps the move has already started and we're just in the early innings. If they continue accumulating and eventually disclose their holdings or weaponize supply through export bans, the next leg higher could be even more dramatic. These counter-arguments have merit, but they don't refute the core thesis. They simply argue about magnitude and timing. The directional trend is clear. Here is what I am watching closely to validate or refute this thesis in the coming months. First, China's Treasury holdings, the monthly tick data. If they drop below 700 billion by the first quarter of 2026, that confirms the liquidation is accelerating. If they stabilize or reverse course, that suggests a change in strategy. Second, China's silver import data from customs reports. If monthly imports continue to exceed 600 metric tons, that confirms sustained accumulation. If imports suddenly drop, that could mean either they've completed their buying or they've shifted to off-market channels that don't show up in customs data. Third, silver export policy. Industry reports and trade publications. If China expands export restrictions or formalizes them into official policy, that confirms they are treating silver as a strategic commodity rather than an ordinary industrial input. That would be a clear signal. Fourth, Taiwan tensions. Monitoring military activity, diplomatic rhetoric, and posturing. If People's Liberation Army exercises intensify around Taiwan or if rhetoric from Beijing becomes more aggressive, that validates the thesis that they are preparing for confrontation and need strategic reserves in place beforehand. And fifth, silver price action itself. If silver breaks above $65 and holds that level, it suggests the market is beginning to price in supply constraints. If it pushes above 70, it's confirming that something fundamental has changed. Above 80, it validates the entire strategic accumulation thesis, and we could be looking at a paradigm shift in how silver is valued. Let me give you the practical implications if this thesis is correct. If China is indeed using Treasury liquidation proceeds to fund commodity accumulation, including silver, several things follow logically. 1. U.S. Treasury yields will stay elevated or rise further. Losing China as a consistent buyer means the United States needs to find other purchasers for its debt. That requires offering higher interest rates to attract capital. Higher yields mean higher borrowing costs for the government, which means larger deficits, which means more debt issuance in a vicious cycle. It also means a stronger dollar in the short term as higher yields attract foreign capital, but that strength masks underlying fragility. 2. Silver's price trajectory will be fundamentally different from what most analysts expect. Traditionally, silver is viewed as a cyclical industrial metal that rises and falls with economic growth. But if a strategic buyer is absorbing supply regardless of price, treating it as a national security asset rather than an investment, that changes the entire market dynamic. Silver starts behaving more like gold, a strategic reserve asset with a floor under the price that reflects geopolitical risk premium. 3. The squeeze could happen suddenly and violently. Markets can remain stable for extended periods before dislocations occur rapidly. If China completes their accumulation phase and then announces their holdings, or if they implement a complete export ban during a crisis, the market could gap higher overnight. We're talking about a potential move from $70 to $100 in a matter of weeks, not months or years. There will be no gradual adjustment. It will be a rush for the exits by anyone who is short or underhedged. 4. Retail investors and small industrial users have a closing window of opportunity. Right now, physical silver is still available at premiums of roughly $7 to $12 over spot price, depending on the product. Coins, bars, rounds can be purchased with reasonable delivery times. But if the China narrative becomes mainstream, if it breaks into broader financial media and public consciousness, premiums could double overnight, then triple. Then product availability disappears entirely at any price because everyone is trying to buy and no one wants to sell. We saw this briefly in 2020 during the pandemic when premiums spiked to $10. Over spot and mints could unkeep up with demand. This time could be worse. The window might be 6 months, maybe 12. After that, if you don't already have physical metal, you will be competing with panic buyers.